Are you wondering how multifamily real estate syndications are structured? Well, in this video, I'm going to walk you through exactly how all the pieces fit together and how syndications are set up. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. And if you don't know me, I'm Seth Ferguson, a 12-year real estate veteran, host of a real estate TV show, host of a real estate investing podcast, and the author of the real estate book, Sell for More. So let's get right into it and talk about how multifamily real estate syndications are structured. And I'm going to draw some circles here. So this is the limit of my art skills. Once I drew a pirate ship on one of these videos, but that's as far as it gets. So we've got two circles here, and we have both sides of a syndication. We have somebody called a GP, called a general partner, and somebody called an LP, a limited partner. And we know from one of my past videos where I talk about what a syndication actually is, and I'll make sure a link goes up right here so you can watch it. We know that by definition, a syndication is a pooling of resources. It's a pooling of capital or money so you can then go out and acquire a much larger asset, in this case, a commercial multifamily deal. But we have two different components of the syndication. We have the limited partners, and these are the passive investors. These are the people bringing capital only. So we'll have a dollar sign right here. They might be doctors, lawyers, accountants, programmers, you name it, business owners. These are typically accredited investors, at least in my case, where they meet the accredited investor thresholds for income and assets, and they're then able to invest in the syndication as a limited partner. There are several advantages of being a limited partner. There's something called a real estate partnership. And this is where it's not a syndication structure like this, but it's where all the different parties are deemed to be active in the investment. But what happens if the deal goes south? Well, because all the parties are active, everybody basically takes the brunt of the lender's wrath and all the other creditors. But in this type of structure, because you're a limited partner, you're not deemed to be a real estate expert. You're bringing your capital, you're investing passively, but you're not taking an active role in the day-to-day operations of the syndication or the property. You're just bringing your money. So you get afforded a number of protections under the law. So let's say a deal, worst case scenario, a deal goes belly up. Well, as a limited partner, sure, you're risking your capital, but that's like investing in the stock market, investing in businesses, investing in all sorts of other investments. There's always the risk of that capital loss, but nobody can come after you for everything else. This is where the general partner comes in. Because as an LP, you're bringing your capital, but you're already doing what you do best in your day-to-day career. You're being a great accountant, you're growing your law firm, you're doing all that sort of stuff. You don't have time to become a real estate expert. Well, the general partner, these are the active workhorses in the syndication because we have the two parts, right? So the general partner, they are the people with the real estate experience. So like myself, I've been at real estate for 12 years now in various forms. They have the network, they have the deal flow. So they're able to get leads in from potential sellers. All the real estate brokers know about their experience. Brokers will approach them with potential deals because they know they can close. They have the necessary network to make sure the deal gets done, because it's not just the general partners that are needed. You need property managers, you need accountants, you need lawyers, you need all contractors, all that sort of stuff. And this is where the GP really makes their money, because they are making the day-to-day decisions that will make these LPs make their money really work for them. Because without the hands-on experience, well, this money could just be sitting dead in a bank account, not being put to work. So the GP will use their experience, their network, all that sort of stuff to make sure the LP's money, their capital, is earning the returns that the LPs are expecting. So this is how it works. So a lot of people in terms of a syndication think, oh, well, I'm buying the property. Well, that's not exactly true. We do have both sides to this, but basically, let me draw the property right here. So this is the property. Well, there's an entity above this, whether it's LP, LLC, whichever structure it's under, but we have the GPs here and we have the LPs here, and they will own shares in this structure. So sometimes let's draw the share deadline here. So the LPs will own these shares, and the GPs will own these shares, and it's the entity that then owns the piece of real estate. So it's very simple when you break it down. You have your passive investors, the LPs. You have your general partners, the active investors. They're the people who have the experience and they're doing all the work. And they come together in this entity, and then the entity itself will own the piece of real estate. So hopefully this clears up how a syndication is structured. It's relatively simple, but if you have any questions, feel free to reach out. Or if you want to learn how you can invest in the deals I'm doing right now, which will follow this structure, head on over to callseth.com and set up a quick 20-minute phone call. And if you like this video, if you found this useful, hit the like button, leave a comment, let me know what you think. And until next time, happy investing.